Let me know if you can hear me and that everything's rolling through okay. Say hi in the chat. Let me know where you're tuning in from. Today we're going to be listening in on a speech from the Governor of the Bank of Canada, Tiff Macklem. Now, if you're not familiar with the importance of this situation, let me fill you in here a little bit. I'm seeing people in the chat. Hi, Justin, Arman, Langton. It's great to have you guys here. So what's happening right now at the Bank of Canada is we're seeing right now in Canada an incredibly high inflation rate, one that we haven't seen since the 80s. And this is a big issue because it adds to the rising cost of living for Canadians. Now, the number one way for inflation to be sort of subsided is for the Bank of Canada to raise interest rates, because when you raise interest rates, it makes it less of an incentive for people to spend money that they don't have, to borrow money. And right now we're seeing that the Bank of Canada might be doing something a little bit different than we thought. Again, let me know that you can hear me okay in the chat there. I'm just going to refresh my chat here because for some reason, there we go. All right, perfect. Now I can see you all. So let's take a closer look at this. We're about to hear Tiff Macklem's speech. I'm not sure if he's actually live as of yet. Okay, it seems like they're just about to start. So
Hopeful
I'm going to tune in
that
here
we
and
will
then
be
we'll,
able
sort
to
of break
welcome you
this
back
down.
in person very soon. Governor Macklem and Senior Deputy Governor Rogers will be pleased to take questions for about 30 minutes or so. But before we go to your questions, Governor Macklem will begin with an opening statement. Alors, Monsieur le Gouverneur, à vous la parole.
Thank you, Paul, and good morning. I am very pleased to be here with you to discuss today's policy announcement and our monetary policy report. I'm especially pleased to have Senior Deputy Governor Carolyn Rogers here with me for the first time. She has joined the Governing Council at an important time. Our message today is threefold. Tout d'abord, nos mesures d'urgence pour soutenir l'économie durant la pandémie ne sont plus nécessaires et ont pris fin.
All right, so like we do whenever you're speaking French, I'm not, my French isn't the best, so I'll give you a breakdown here. It looks like the Bank of Canada is going to hold their interest rate at the same rate that it is currently, which says to us, hey, like they're not doing anything to tackle this inflation problem, and as a result, the housing market could continue to run, inflation could continue to run, but there will be further sort of support for the economy with low interest rates because that allows people to borrow more and allows businesses to borrow more to expand.
First, the emergency monetary measures needed to support the economy through the pandemic are no longer required, and they have ended. Second, interest rates need to increase to control inflation. Canadians should expect a rising path for interest rates. And third, while reopening an economy after repeated waves of COVID is complicated, Canadians can be confident that the Bank of Canada will control inflation. We are committed to bringing inflation back to target. Let me take each of these in turn. The bank's response to the pandemic has been forceful. Throughout, our actions have been guided by our mandate. We have been resolute and deliberate, communicating clearly with Canadians on our extraordinary measures to support the economy and on the conditions for their exit. When we introduced emergency liquidity measures to support core funding markets, we said they would end when market functioning was restored. And they did. When we launched quantitative easing, we said it would continue until the recovery was well underway. And as the recovery progressed, we began tapering QE and ended it in October. Today marks the final step in exiting from emergency policies. We said exceptional forward guidance would continue until slack was absorbed. With the strength of the recovery through the second half of 2021, the Governing Council now judges this condition has been met. As such, we are removing our commitment to hold our policy rate at its floor of 0.25%. Second, we want to clearly signal that we expect interest rates will need to increase. A lot of factors are contributing to the uncomfortably high inflation we are experiencing today. And many of these are global, and they reflect the unique circumstances of the pandemic. As the pandemic fades, conditions will normalize and inflation will come down. However, with Canadian labor markets tightening and evidence of capacity pressures increasing, Governing Council expects higher interest rates will be needed to bring inflation back to the 2% target. And finally, Canadians can be assured the Bank of Canada will control inflation. Prices for many goods and services are rising quickly, and this is making it harder for Canadians to make ends meet, particularly those on lower incomes. Prices for food, gasoline, and housing have all risen faster than usual. We expect inflation will remain close to 5% through the first half of 2022 and then move lower. There is some uncertainty about how quickly inflation will come down because we've never experienced a pandemic like this before. But Canadians can be assured that we will use our monetary policy tools to control inflation. Let me now turn to the economic outlook we've outlined in our monetary policy report. À l'échelle mondiale, la reprise est robuste, mais inégale. Les problèmes d'approvisionnement continuent d'être un obstacle. Avec la forte demande de biens et les prix plus élevés de l'énergie, ces problèmes ont fait monter l'inflation mondiale. En réaction, les attentes indiquent maintenant que la détente monétaire pourrait être réduite plus tôt et les conditions financières très accommodantes se sont resserrées. In Canada, growth in the second half of 2021 was even stronger than we had projected, and a wide range of measures now suggest economic slack is absorbed. With the rapid spread of the Omicron variant, first quarter growth is likely to be modest, but we expect the impact on our economy to be less severe than previous waves. We forecast annual economic growth will be 4% this year and about 3.5% in 2023. We're expecting consumer spending on services to rebound and business investment and exports to grow solidly. CPI inflation is currently well above our target range, and our core measures have edged up. Global supply chains, weather-related increases in agricultural prices, and high energy prices have put upward pressure on inflation in Canada, and that is expected to continue in the months ahead. These pressures should ease in the second half of 2022, and inflation should decline relatively quickly to around 3% by the end of the year. Further out, we expect demand will moderate and supply will increase as productivity improves. This will ease price pressures and bring inflation gradually back close to our 2% target over 2023 and 2024. Let me now say a few words about the Governing Council's deliberations. Of course, we discussed the impact of Omicron. Renewed restrictions and household caution about this highly infectious variant have temporarily slowed economic activity. Once again, high-contact service sectors have been hardest hit. But with many more Canadians getting infected in this wave, worker absences have been more widespread. Our high rates of vaccination and adaptability to restrictions should limit the downside risks of this wave. Governing Council also spent
I want to take a second here to just explain what we're hearing and why it's so shocking, right? We're hearing that the Bank of Canada is going to keep their interest rates at the same point that they've kept them at throughout the pandemic. Now, many people believe that due to these low interest rates and the quantitative easing or the money that's been added to the system, kind of like money printing, but it's not actually printed, it's just digital, right? Many people believe that this is the root cause of why we're seeing so much inflation, such a rising cost of living, both in terms of asset prices like real estate and housing, as well as on consumer goods like inflation and the CPI that we'd see today. So many people were expecting, okay, they're going to have to do something because the only way that they can slow down inflation from a monetary policy standpoint is to raise interest rates. And that's not what they're doing. But what they are doing is saying, hey, we're going to raise them in the future. Just like they said before, we're going to raise them in the future. A big thing in central banking is giving forward guidance or sort of telling people what you're going to do in the future. A lot of the times they tell people they're going to do something in the future because that causes a reaction in the markets that may make it so that they don't have to do that thing in the future. So right now it seems like they're issuing this forward guidance that, hey, we're going to need to raise interest rates So don't take on a bunch of debt, don't continue this inflation, but whether or not this kind of guidance that they're giving will actually do anything when they haven't actually changed their monetary policy is yet to be confirmed.
Spent considerable time assessing the overall balance of demand and supply in the economy. In October, we projected the output gap would close sometime in the middle quarters of this year. While measuring the output gap is always uncertain, and pandemic-related distortions make assessing supply more complicated, a broad range of indicators clearly suggest economic slack has been absorbed more quickly than expected. Employment is above pre-pandemic levels, businesses are having a hard time filling job openings, and wage increases are picking up. Unevenness across sectors remains, but taking all the evidence together, the Governing Council judges the economy is now operating close to its capacity. We debated the most likely path for inflation. The resolution of global supply bottlenecks has important implications for inflation in Canada. There is some evidence that supply disruptions may have peaked, but the spread of Omicron is a new wild card, and that could further disrupt global supply chains. We also considered the potential for some reversal of the large price increases we've seen for goods. This would put downward pressure on inflation. This would bring inflation down more quickly than we forecast. Overall, we judge that the risks around our inflation projection are reasonably balanced. We also assessed more domestic sources of inflationary pressures. While global goods price inflation is expected to ease, the tightness in Canadian labor markets, rising house prices, and evident capacity pressures suggest that if demand continues to grow faster than supply, this will put upward pressure on inflation. We noted that measures of inflation expectations are broadly in line with our own forecast, with longer-term expectations remaining well anchored on the 2% target.
Another thing to note here is that we're getting the sort of vanilla PC answers right now and statements from the Bank of Canada where they have to be very, very careful about what they say. When we get to the good stuff, this is the questions from reporters that are likely about to come after this speech. That's when we're going to get some more critical takes, and maybe the Bank of Canada is going to have to answer some questions that they may not want to answer and tend to slip up when giving the answers that give us a better picture of what they actually think.
We agreed it is paramount to ensure that higher near-term inflation expectations don't migrate into higher longer-term expectations and become embedded in ongoing inflation. Putting all this together, we concluded that consistent with our forecast, a rising path for interest rates will be required to moderate spending growth and bring inflation back to target. Of course, we discussed when to begin increasing our policy rate. Our approach to monetary policy throughout the pandemic has been deliberate, and we were mindful of the rapid spread of Omicron and the fact that it will dampen spending in the first quarter. So we decided to keep our policy rate unchanged today, to remove our commitment to hold it at its floor, and to signal that rates can be expected to increase going forward. As we indicated in our press release this morning, the timing and pace of those increases will be guided by the bank's commitment to achieving the 2% inflation target. Nos actions ont été bien réfléchies depuis le début de la pandémie.
Okay, so they're saying, one of the reasons that we're not raising interest rates yet is because we don't know how Omicron's going to shape out, and maybe we need to continue this economic support. But at the same time, they're saying, hey, all of the slack in the economy, all of the people who can't get jobs, or many of them, and the sort of labor market is recovered in average, he's saying. It's still uneven. More people with high income having jobs and more people with low income not having jobs. But on average, they're saying that this is pretty close to how the economy was operating before the pandemic. So with that said, you'd think that they would raise interest rates, but here's more English.
For almost 2 years now, we have told Canadians we would keep our policy rate pinned at its floor until slack is absorbed. With slack absorbed more quickly than expected, it's time to remove our extraordinary forward guidance. This ends our emergency policy settings and signals that interest rates will now be on a rising path. This is a significant shift in monetary policy, and we judge that it is appropriate to move forward in a deliberate series of steps. Let me say a final word about another important monetary policy tool, our balance sheet. The bank will keep its holdings of Government of Canada bonds on its balance sheet roughly constant, at least until we begin to raise the policy interest rate. At that time, we will consider exiting the reinvestment phase and reducing the size of our balance sheet by allowing maturing Government of Canada bonds to roll off. And as we've done in the past, before implementing changes to our balance sheet, we will provide more information on our plans. With that, Senior Deputy Governor Rogers and I will be pleased to take your questions.
Merci beaucoup, Monsieur le Gouverneur.
Wow, so that's another interesting note. So they sort of mask this in this banker speak, but essentially what he just said is significant in regards to their balance sheet. Now, right now, the Bank of Canada creates new money, or throughout the time that they were doing quantitative easing, they create new money to purchase Government of Canada bonds. The Government of Canada issues these bonds as sort of like loans that they're taking from the Bank of Canada to enact all of their policies, like so many of these benefits and the extraordinary spending that's gone on throughout the pandemic. What they're saying here is that even though they're not adding new money to the system now with QE or quantitative easing, what they will be doing is that whenever those bonds expire that they're holding from the Government of Canada, they're just going to repurchase them. So the amount of debt that Canada has right now, the Bank of Canada is going to keep bankrolling, but there's not going to be sort of more money added to allow for more purchasing of those bonds. This has an effect on interest rates as well, because when the Bank of Canada is buying up tons of bonds, it keeps interest rates low because the high price of bonds driven by the demand that the Bank of Canada is adding to the market, well, that keeps interest rates low because bond prices and yields are sort of inversely correlated. But now is the good stuff. Now is the good stuff that we've been waiting for. Is these questions, right? From these the reporters here in the Bank of Canada press conference. This is where we get some critical takes of, hey, maybe you're not doing the right thing. Let's listen in and we'll sort of talk more about it soon.
And we will go to questions now. We do have quite a long list of questioners, so I will ask everyone to please limit yourself to a single question so we can get to everybody who is on the list today. And I will also ask everyone to kindly make sure your line is muted. If you're not asking a question, you can do so by pressing *6, and unmute when it's your turn by pressing *6 again. Pour mettre votre ligne en mode discrétion, appuyez sur *6, et pour l'enlever, faites *6 encore une fois. If I fail to identify you when I call on you, please state your name and affiliation. Et bien sûr, libre à vous de poser vos questions dans la langue officielle de votre choix. So let's get started, please, with Julie Gordon from Reuters.
Yes, hello. Hi, Governor. Thanks for taking our questions, and welcome, Senior Deputy Governor. Some economists and members of the business community were surprised by the hold. One even called this a misstep. Can you explain why you decided to wait longer, especially as you're saying slack has been absorbed and inflation will be higher than you previously thought?
Yes, and I'm going to, the Governing Council certainly had a full deliberation, and I'm going to also ask Senior Deputy Governor Rogers to give her perspective. Look, today we announced a significant shift in monetary policy. And the short answer to your question, Julie, is that we judged that it was appropriate to move forward in a deliberate series of steps. Today's decision is consistent with our deliberate approach we've taken throughout this pandemic, and it also reflects the fact that Omicron is weighing on the economy as we speak. From the start of this crisis, we've been resolute and deliberate. There's been a lot of uncertainty, and reopening the economy as the variant continues to reverberate through the economy and mutate has proven complicated. By being clear and deliberate, we're really trying to cut through the noise so that monetary policy is more of a source of confidence, and it's not another source of uncertainty. From the start of this pandemic, we've been very clear about the extraordinary measures we're taking to support the economy, and we've also been very clear about the conditions for exit. At the beginning of the crisis, we put in place emergency liquidity, and we indicated we'd remove that when market functioning improved, and we did that. When we launched quantitative easing, we indicated it would be in place until the recovery was well underway. As the recovery progressed, we began tapering QE, and we exited in October. Today, we're exiting the final piece of our extraordinary policy response. We're removing our exceptional forward guidance. We're signaling to Canadians that they can expect a rising path for interest rates. And we're also indicating that once we've increased our policy rate, we will consider shrinking our balance sheet. This is a significant shift in monetary policy, and we judged it was appropriate to move forward in a series of steps. As I said, we're also mindful that Omicron is weighing on the economy, and we are going to learn more about Omicron in the coming weeks. But as I said, Senior Deputy Governor Rogers was also around the table, so let me turn to her for her perspective.
Thanks, Governor, and thanks, Julie, for the welcome. Let me first say how pleased I am to be here and how I look forward to future opportunities like this to speak with you. So, as the Governor said, there was a high-level consensus among the Council on the key indicators. Certainly, there was broad agreement that slacks absorbed, and that led us pretty easily to the decision that emergency measures like forward guidance were not needed anymore, and it was time to remove them. And to the message to Canadians that we need to, that we're on our way to a rising path to interest rates. So those decisions, they were considered carefully, but there was a very high level of consensus. And then, as the Governor said, Omicron weighed on the Council's decision. From an economic perspective, this wave of the virus looks to be to have less severe economic impacts, owing in part to less severe health impacts. Certainly, this is credit in part to a high vaccination rate in Canada, but also to the adaptability of Canadians and Canadian businesses to the virus so far. Having said that, certainly we've seen an effect on economic activity in the first quarter, employee absenteeism and increased measures, and of course, understandably, consumer caution has weighed on activity. But as we said, we think that that effect will be shorter lived, and if that proves to be true, we think an economic rebound is around the corner.
Right. So it seems like they're not being as quick to increase interest rates right now because in the Bank of Canada's belief, a lot of this inflation that we're seeing is brought on by supply chain pressures. The governor of the Bank of Canada, Tiff Macklem, also said unique weather on like food prices and like how much we're able to like have a supply of that food driving up food prices. So they're saying like that all of these things, while they're expecting them to sort of solve themselves and for this inflation that we're seeing to sort of eke back down and go on a deflationary rate. Now, this is something that could happen. There's lots of people who believe that we could be seeing deflation in the future, and this could be a downward pressure on the current number that we're seeing. And certainly people who are very heavily following tech stocks and things like this are saying, okay, well, this, for example, let's say you bought a TV, a 60-inch TV in the year 2000. You were paying $3,000, $4,000 for that, but now you can get the same thing for under $500 in Canada, right? So the increase in technology is a deflationary pressure, and a lot of people think that alongside these sort of issues resolving, like the supply chain bottlenecks, well, tech is going to draw down inflation by itself. Now, whether or not that's the case remains to be seen, but it seems like the Bank of Canada is trying to not be so quick to raise interest rates, potentially affecting housing prices negatively, and the spending in the economy to go down if they were to raise those interest rates. But they're saying, hey, we promise we will do it soon, but who knows when.
Okay, our next questioner will be Greg Quinn of Market News, followed by Paul Vieira from the Wall Street Journal. Greg?
Good morning. The bank's inflation forecast for this year was raised today to 4.2%. In October, it was a prediction of 3.4%. In July, it was 2.4%. What is it that has made inflation so difficult to predict, and what gives you confidence that long-term expectations are going to stay in order?
As I just outlined, much of the inflation we're seeing today really reflects global factors, and the unique circumstances of the pandemic. We've seen global supply chains are gummed up. There are all kinds of logistical problems. Combine that with the fact that households being unable to buy a lot of the services they want during the pandemic have shifted to goods. Goods need to be produced, they need to be transported. And given the disruptions in global supply chains, that has all put upward pressure on goods. So, goods prices are rising much faster than normal. And that is largely the reason, together with rising energy prices and more recently rising agricultural prices, is really why inflation is well above our target. In chart 9 in our monetary policy report, we do a good job of decomposing that for you. Why are we confident that inflation is going to come back down? Well, we're starting to see some evidence that these global supply chain issues are starting to get resolved. If you look at shipping costs, if you look at port backlogs, they look to have peaked and in some cases coming down. Omicron is a new wild card. It is reverberating around the world. It could create some new problems. But as this pandemic recedes, two things should happen. One is households should be shifting away from goods back towards more services. That should relieve some of the demand pressure on goods. And these supply chain disruptions should get resolved and work their way through. We do think that's going to take some time. There are backlogs. And so we do think inflation is going to remain around 5% through the first half of this year. We then think it's going to come down fairly quickly through the second half of the year to about 3% by the end of the year. The other element is, as we've signaled, we expect to be raising interest rates, and that will dampen demand growth and ensure that domestic sources of inflation do not build up and inflation comes back to target.
Thanks. We'll go to Paul Vieira now, followed by Eric Hertzberg of Bloomberg.
Can you hear me?
Yes, very well.
Yes. Okay. Thank you. Governor Macklem, was Omicron the only reason the central bank decided to hold off on raising rates today? Because the outlook, the NPR has a rather bullish outlook on the economy. You said that slack is absorbed, and that there is a risk that higher inflation expectations get embedded into the economy. Can you please answer?
Certainly, Omicron was a factor in our decision. We are mindful that Omicron is weighing on the economy as we speak. We have a pretty modest growth forecast for the first quarter. But as Senior Deputy Governor outlined, we are hopeful that Omicron is fairly short-lived. Certainly, there is some evidence coming out of public health that it may have peaked and is beginning to come down, and we're starting to see some restrictions removed. So we are expecting a fairly good rebound. Look, there is uncertainty about Omicron. We're going to learn more about the path of the virus in the coming weeks. We were mindful of that. But what I would stress really is that we announced a significant shift in monetary policy today. We have removed our exceptional forward guidance. We've signaled clearly to Canadians that they should expect a rising path for interest rates. And we've also indicated that once we raise rates, we will be considering quantitative tightening. That's a big shift, and consistent with our deliberate approach through this pandemic, we judged that it was appropriate to move forward in a series of steps.
Okay, wow. So I want to emphasize something that for central banks like the Bank of Canada, the Federal Reserve in the States, the European Central Bank, almost as powerful in their eyes as actually using their monetary policy tools to affect the economy is to use forward guidance or signaling. You'll hear them talk about signaling absolutely all the freaking time. This is what they use so that they don't have to actually use their tools, because a lot of their tools are one-shot tools, right? You can only go so far raising interest rates before you have other economic problems from raising those interest rates. You can only go so low so quickly, as we saw in the pandemic, before you see rising inflation, right? So instead of actually doing things, they want to say, we are being very clear here, very stern with the Canadians and with people around the world. We are going to do something. Interest rates will rise. Interest rates will rise. And in their eyes, is like, okay, if we are very clear that we're going to do that, we'll actually see the effects in the economy from people who are acting under the information that we're giving them here, that we're going to do something. So this is a little bit of a interesting note for central bankers and how they actually function here and what that signaling is and forward guidance is. The other thing they mentioned here is quantitative tightening. We've talked about this already a little bit on the stream. Quantitative easing was when they added a bunch more money into the system by buying up Government of Canada bonds. That's essentially funding the Canadian government to do what they needed to do throughout the pandemic. What they're saying is that in the future, hey, again, this is more signaling, we're not doing it yet, but we might, is quantitative tightening, where they allow those bonds to expire and don't repurchase them. That will cause rising interest rates, and it also might lead the Government of Canada into a sticky situation where they have to issue higher interest rate bonds to banks and large, like big blue chip banks to take on their debt, instead of having the Government of Canada or the Bank of Canada to just allow them to take on this debt. So it's going to be interesting to watch, but let's see if there's any more juicy questions like that.
Thanks. We'll now go to Eric from Bloomberg, please.
Hey, good afternoon, Governor, and welcome to Senior Deputy Governor. We have inflation here at a three-decade high and still rising. Forecasts you released today show slack essentially absorbed, employment near full. Central bank credibility is a delicate thing. I'm just curious whether you could talk a little bit more about whether or not you believe not hiking interest rates in the context negatively impacts the bank's credibility.
I think we've been very clear today that we've announced a significant shift in monetary policy. We have signaled very clearly to Canadians that they should expect a rising path. The time for emergency policy settings is over. That really reflects the fact that, yes, inflation is uncomfortably high. We do expect inflation is going to come down fairly quickly in the second half of this year as the problems in global supply chains get resolved and the pandemic recedes. But we also see that, as you just indicated, slack is absorbed. And that means that we do need to bring demand growth in line with supply, and that requires a rising path for interest rates. When we look at inflation expectations, what we see is that near-term inflation expectations have gone up, and actually those are very consistent with our own forecast. We are expecting inflation to remain around 5% through the first half of this year. But the other thing you see when you look at inflation expectations from surveys, from markets, medium and longer term inflation expectations remain well anchored on the target. And that too I think that reflects the confidence that Canadians have that we will bring inflation back to target. One thing I can tell you about our deliberations was that we all agreed it was paramount that we take action to ensure that this rise in near-term inflation expectations doesn't start to migrate to medium and long-term inflation expectations, because if that happens, it will become embedded in longer-run inflation expectations. And the best way to keep inflation expectations well anchored on our target is to get inflation back to target.
So That was quite the answer. You hear him saying expectations, inflation expectations. This is because in the economy, it's not just a matter of like what's happening now, but also what people think will happen. If people think that that there will be more inflation in the future, if the Canadian public thinks that there will be more inflation, things will be more expensive later. They're more incentivized to buy those things now. Now that creates additional demand for the goods that they're purchasing. That sort of like as a flywheel there, right? Things are going to be more expensive in the future because more people are buying things. There's more demand. So I'm going to buy now because it's going to be more expensive. And you can sort of see how that sort of cycle starts to get into a situation where you have increased inflation over the long term. So this is what he's talking about, signaling expectations. It's all about what people think and what people are going to do and how their behaviors are going to change based off that information.
Okay, next on my list, I have Jordan Press of Canadian Press, followed et ensuite, il y aura une question du TVA. But Jordan first, please.
Good morning, Governor and Senior Deputy Governor. My question has to do with looking at the labor market. In the NPR, while it shows a number of indicators have recovered, there are still quite a few that are still far below the recovery point. And I'm wondering how much that has affected maybe some of the decisions you are going to be making about the path for any rate hikes, and maybe what you want to tell those people who are maybe still long-term unemployed in this country about what your changes in monetary policy may mean for them.
In our report, we have quite an extensive discussion of labor market indicators, and maybe I'll ask Senior Deputy Governor Rogers to say a few words about how that factored into our deliberations.
Yeah, I think your point is a good one. I think if you're employed in the hard to distance sector, if you're sitting in a community that's reliant on tourism, it probably doesn't feel like the labor market's fully recovered. But as the governor said, and as you'll see in our report, we look at a broad range of indicators, and overall, what we observe is that employment participation rates are back up to near pre-pandemic levels. There's pressure on wages, and employers are having a hard time hiring employees for a high level of vacancies. So in total, those things say to us that the labor market is tightening and slack is absorbed.
So they're saying slack is absorbed, people are working, and if you're in a sector where it's hard to get a job or you still can't do your job, well, you're on the bottom end of the average. We need to act for the average. Screw you. Like, that's the frustrating thing. It's like if you were in the central banker's shoes, maybe you do the same thing. It's like, how do you make these changes to policy to help absolutely everyone? But it definitely seems like the people who have traditionally gotten the short end of the stick on the lower income sort of side of things are once again getting that same shorter stick.
D'accord. Passons maintenant à Olivier Ferron-Boissé du réseau TVA.
Oui, bonjour. J'espère que vous m'entendez.
Direction de politique, on a indiqué que steps, and then we might pause automatic. The path doesn't end.
Back to neutral. Rates are going to. As you say, we're entering a rate hike cycle. Rates are going to start going up in the next little while. How high do they need to go to get to a point where the bank is no longer stimulating the economy and you're kind of getting back to neutral?
Mark, I think we've really been quite clear today that interest rates, everybody should expect interest rates to be on a rising path. I'm not here to validate the market curve, I'm not here today to tell you, exactly how fast or how far they're going to go up. But, a path does signal a few things. First of all, as I just indicated in French,
signal.
A path is not one move. A path is a number of steps. Secondly, a path, the path doesn't mean we're on autopilot. It's not automatic. And we will be assessing at each meeting. And a path doesn't rule out that you would take a few steps and then we might pause and assess progress. Those are decisions we're going to need to take moving forward. The other thing I'd say about the idea of a path is we are starting from exceptionally low interest rates. And when you start at the effective lower bound and you're indicating a path, the implications for interest rates are pretty straightforward. There needs to be a series of steps. As you get further down that path, the decisions will become more finely balanced, will become more data dependent. So, I think the message is pretty clear. We're on a rising path. How far and how fast, those are decisions we'll take at each meeting, depending on economic developments, depending on our outlook for inflation, and what we judge is needed to bring inflation back to target.
I think every time he says signal or
Thanks. We'll
expectations
go now
or
to
path,
Michelle
we
from
should just spam
BNN,
signal
followed by
in the chat.
Rule of
This is
Epoch
the central
Times.
banker
Michelle.
way.
Hi there, can you hear me?
Yes, Michelle.
My question is, on BNN, we've had a lot of mortgage experts saying that there's been an increased demand for variable rate mortgages. So some of these borrowers are thinking the bank is not going to hike as much as the market thinks. What would you say to those people?
I'm going to ask Senior Deputy Governor Rogers to take this question.
Yeah, thanks, Michelle. So, as the governor said earlier, we're not in the business of giving financial advice, whether to take a fixed or variable mortgage rate. As it relates to housing, I think our forecast is clear what we see the path for housing to look like. Housing activity has been elevated for a while now in Canada, and housing affordability has been a persistent problem. You can attribute it to a number of things. Certainly low interest rates is one of those factors. A recent spike up in prices has also brought investors into the market, more investors into the market. That's something the bank has published research on recently. Overall, the bank's view is that the most important thing that will restore balance to the housing market in Canada is an increase in supply. Supply has not kept pace with demand, and we think that's an important thing that needs to happen. So we're encouraged by recent conversations in that direction.
Okay, that's interesting. Before we go on, Alex, thank you so much for the super chat. I appreciate you supporting the stream. Alex says, how can the government use emergency restrictions to limit work and production and then even consider raising rates? Hey, a little potato. Yeah, I mean, it's definitely interesting to see how they're balancing these things, like having emergency restrictions in many provinces right now, but then potentially considering raising rates, which can make it so that less people work because there's less demand for labor in those instances. Usually when you lower interest rates, you get more job growth. So that's interesting. And then the question here that this senior deputy governor of the Bank of Canada has just answered is about variable rate mortgages. What are people going to do if they're locking in these variable rate mortgages where if the Bank of Canada raises rates, they could be paying more on their mortgages? And this is a problem across the sector that lots of people are going to be dealing with if the Bank of Canada does actually increase these interest rates. But they don't give a lot of detail here on how they think that their actions could affect the housing market, because that's not in their mandate. Their mandate is to keep inflation on track and facilitate a well-functioning economy in Canada. So they're just saying here, hey, the housing thing, it's not our problem, even though maybe our low interest rates that we kept for so long boosted the housing market, as well as all the new money that we added that trickled its way down into the economy and largely into housing. That wasn't the main issue, it's just supply. Of course, supply is a big issue. We're not seeing enough building of new homes in Canada for a number of reasons, but they're saying that is the main reason, not the low for long interest rates or the quantitative easing.
But overall, coming back to the forecast, we think housing activity will stay elevated for a while. Certainly, our message today that more interest rates are on a rising path will feed through to mortgage rates and likely moderate demand over time.
Okay, we'll go to Raul of Epoch Times now, and followed by Craig Lord from Global.
Yes, hello, and good morning.
the NPR mentioned the assumption that oil prices remain flat and the boost from higher gas prices should also fade in the coming quarters. And I understand that you hold your oil price projection flat the projection period, but it's been well over $80. Now it's like 86. The projection is 75, what you're using, and some say it could go to 100. What would that do to your inflation forecast? And would the bank need to get more aggressive with rate hikes? Like, it's not mentioned as a risk factor, but I understand that it is a double-sided risk. Like, is it more tilted up or down in terms of a risk factor?
Well, let me say a couple words about oil prices, and then I'll look. You got to look at the full range of risks. With respect to oil prices, yes, our standard convention is to use a flat profile for oil prices. If you actually look at the futures curve right now, it actually has oil prices coming down a little bit. So in that sense, it's a bit higher than if we'd use the futures curve. Look, there are certainly, we know oil prices can be volatile. So, there are risks on both sides there. When we look at the risks to our inflation forecast overall, yes, there are certainly some upside risks. It could take even longer for these global supply chain issues to get resolved. Oil prices could spike higher. On the other hand, when we've seen in the past, when you've seen big increases in good prices, it's not unusual to see some actual reversal of those prices. If we actually saw a reversal, inflation would come down more quickly. To give you an example, we ran a simulation, a scenario where there's a 30% reversal in global goods prices. That would actually bring inflation down somewhat a little bit below the 2% target next year. When we look at the full range of risks around our inflation forecast, we judge that they are reasonably balanced. Having said that, inflation is uncomfortably high, and so we are more concerned about the upside risks than the downside risks. And we will be using our tools to manage those risks going forward.
A quick poll of people in the room. If you look at chat right now, there's a question here I'm asking of you. Do you think that inflation's here to stay, or do you think that it's going to be short term? I'm curious what the sort of overwhelming sense in the room is as we continue to watch here.
Okay, our next questioner is Craig Lord from Global News. Craig, please go ahead.
Good morning. Thanks for taking the questions. I'll actually ask you to maybe expand a bit on what you were just saying there, Governor Macklem. The possible reversal of growth in goods prices that you've listed as uncertainty. Could you explain a little bit about what would cause that, and maybe even how likely a scenario that is looking forward in the few months ahead, that possible phenomenon and its impact on inflation?
Well, we've been faced with a very unique set of circumstances that has put a lot of upward pressure on globally traded goods. It's a combination of, a very rapid global recovery from COVID. That's a very good thing. And one of the features of this recovery is because people everywhere in the world can't consume as many services as they want. They can't go to restaurants, so they're buying new equipment for their kitchen. They can't go to the gym, so they're buying home gym equipment. Those goods have to be produced. They need to be shipped, and against a background of an impaired global supply chain that is being affected by COVID, where production is, some production plants have had to close, production has had to be slowed down, transportation gets slowed down. That has all put a lot of upward pressure on goods. As things move forward, we expect a couple of things to happen. As the economy continues to reopen, we expect people to shift away from goods back towards more services, so we think demand for goods will come off. And as these global supply chain issues get resolved, production should come up, logistic problems should work their way through, and there'll be more supply. So in that scenario, it's not hard to imagine that you get actually some reversal of goods prices. We haven't built any reversal of goods prices into our projection. If you were to put them in the projection, inflation would come down faster than we've forecast. We haven't done that because there are also risks on the other side. There is some uncertainty about how quickly these supply issues will get resolved. There is still uncertainty about the course of the virus, or Omicron is reverberating around the world. And as I said earlier, we think we've taken a pretty balanced view with respect to our inflation forecast.
Okay, so that's interesting. And just closing this poll now, it seems that about 4 out of 5 people in the chat think that inflation is here to stay, which could say something about the expectations of the average Canadian. If we think that inflation is here to stay, well, that's more of an inflationary pressure, right? Again, like I said, you're going to buy things that now instead of later because they're going to be more expensive in the future, causing more inflation. It's interesting to see that the Bank of Canada's signaling isn't doing as much as maybe they think.
Okay, thank you. We do have time for one more question, and I am going to ask that for Tony Mace of Mace News, please.
Hi, Governor. In the statement today, it says the bank is planning to consider exiting the reinvestment phase once we begin raising rates. Can you tell us how we should be thinking about that process as it relates to interest rates? I mean, is quantitative tightening equivalent to a rate increase or more than one? Thank you.
Okay, a few things on that point. So first of all, what we said today is that once we raise interest rates, we will be considering exiting the reinvestment phase and allowing at least some roll-off of Government of Canada bonds from our balance sheet. At this time, we're not actively considering outright sales of Government of Canada bonds, but once we increase rates, we will be considering allowing Government of Canada bonds to roll off. In other words, not be replaced. And before we implement any changes, we will provide more information on how we would operate should we move forward with that. With respect to how to think about quantitative tightening relative to interest rates, a couple of things. First of all, we've been very clear today telling Canadians that they should expect a rising path for interest rates. And as I've already explained, that's not one move, that's a number of moves. We do view interest rates as our primary monetary policy tool. Our balance sheet, decisions we would take on our balance sheet would supplement that. So hopefully that gives you a clearer picture of how we see it. And with that, I think, thank you very much.
That, in fact, concludes today's press conference. So thanks very much, Governor Macklem and Senior Deputy Governor Rogers. And thanks to the reporters for participating. And thanks to all of you for watching and listening. À la prochaine.
Wow. Okay. So that's the end of the press conference. So for those who maybe joined halfway through, let's just take a second here to provide a summary for what we just watched together and what that means for you and sort of what we expected and then what actually happened. So I'm gonna go through this rather quick, but hopefully that this helps people understand exactly what's going on here. So today was the Bank of Canada's day where they were going to decide: are we going to raise interest rates? Or are we going to lower them? This has effects on absolutely everyone. We have high inflation here in Canada currently, so the rising cost of living is sort of increasing faster and faster. The number one way the Bank of Canada can control this is by raising interest rates or by doing something called quantitative tightening, which is a little bit more complex, but essentially it's where the Bank of Canada no longer will buy Government of Canada bonds, and this as well increases interest rates. So this is the big decision. Will they keep it the same at the extremely low interest rates that we currently have, or will they boost it up, which is what everyone or many people were expecting? Today we found out they will not be boosting these rates yet. They're going to keep it at this extremely low interest rate for the time for currently. There's another rate decision in 3 months, and what they're saying now is, hey, we are making this big event right now today. We are saying in the future, we're going to raise interest rates. We're going to do this. There's a path of rising interest rates ahead of us. Now, this is something that's important because central bankers often like to signal what they're going to do in the future because they hope that that will get some sort of response from the Canadian population. If we say interest rates are going to go up in the future, well, maybe they'll start acting like interest rates are actually higher now because they know they're going to be higher in the future. Less people locking in loans that have variable rates because they think that there's going to be higher interest rates in the future. So that was their decision, and we got a lot of questions about it. A lot of questions from the reporters in the session that were all curious about why exactly they were doing this. The number one question was, hey, why are you not raising interest rates if we have a record high inflation? This doesn't quite make sense, especially when the Bank of Canada said that the labor market slack has been absorbed. Now, this is central banker speak for saying, hey, most people, they're back to work. On average, Canadians are back to work and are not having trouble finding work. The unemployment rate is as low as it was before the pandemic, so we can now say that the labor market slack is absorbed. So as a result, that would indicate that you wouldn't need to have low interest rates, because when you have low interest rates, it usually adds more jobs because businesses can borrow for less money and hire more people. This is sort of the loose way that affects the jobs market. But even with that being the case, they didn't raise rates, even though they're saying that the economic slack has been absorbed, or the job market labor slack has been absorbed. Instead, they say that due to Omicron, they're still uncertain as to what exactly is going to happen, and maybe the economy needs a little bit more support, so we're going to keep our interest rates as low as they have been throughout the entire pandemic. Now, what does that mean for you? Number one, over the short term, it doesn't seem like there's going to be a slowdown in the real estate markets because we have these low interest rates, right? We have this cheap money that people can borrow. When we have low interest rates, the same people who could qualify for less mortgage before, well, they can qualify for more mortgage because their payments are lower on the higher amount of money borrowed. So this is what's driving up the real estate market. And so likely we're going to see that continue to rise as well. We're likely to see inflation continue to rise, or at least stay up where it is around the 5% mark over the short term, because again, when there's low interest rates and high inflation, people are more incentivized to go out and buy things right now today because in the future, those things are going to be more expensive. That causes more demand, and that demand sort of translates into even more inflation. So it's this flywheel that keeps on going and keeps on going. So that was their response to it, that, hey, we don't know what's happening with Omicron. We think that some supply chain issues that are rising the cost of living, well, they're going to get sorted out. And some of these sort of other short-term things, well, they're going to get solved on their own. So we're not going to do anything yet, but we're going to signal that we're going to raise rates in the future, and hopefully people will listen to what we're saying here. So it's going to be really interesting to look at going forward and find out, hey, in March, are they even going to raise rates? Because they're stuck between a rock and a hard place right now. Many Canadians, especially Canadians who aren't on the lower side of income and savings and wealth, higher wealth Canadians tend to have stock portfolios and real estate portfolios and investments, right? When we have low interest rates, investments do really, really well because these big companies can borrow a lot of money, and that's good for the investors that are invested in them. They can borrow money for cheap. But when we have a raising interest rate environment, well, a lot of these sort of these investments, both real estate and stocks and equities, those can tend to go down in value. So no matter what the Bank of Canada does, you're going to have half of the population a little bit pissed off about it. So it's interesting to see what they're prioritizing and who they're prioritizing. And then additionally, we're seeing a lot of pressure from the federal government, right? We have the Conservatives that are pressing the Liberals, saying inflation is awful, it's because of your spending, Trudeau. And this could very well become a political issue if if inflation stays around for very much longer. So the fact that they're keeping interest rates low could be a bad look for Justin Trudeau and the Liberals, especially when so many people are feeling the effects of this higher inflation that, at least for the short term, isn't going to be dealt with by the Bank of Canada, even though they're signaling, we say on the live stream, signal, even though they're signaling that this is going to happen, they're not actually doing it yet. And it's not even confirmed that they will do it in the future, even though their forward guidance is that they will. So hopefully that's a good summary for you. This is likely something that I'm going to clip out of the live stream and throw it onto the YouTube channel as its own video. So if you're watching this after the fact, make sure to join me next time we have a live stream. We watched the whole interview with Tiff Macklem, and you can watch the recording of it after you watch this sort of summary. So hopefully that helps you out at least a little bit. And everyone who's here on the stream, it's interesting stuff, right? It's very interesting what's going to happen going forwards. And that's about it for new information that's coming. As I like to do at the end of these streams, if anyone has any questions at all about anything, you can drop it in the chat. Just use @RussellMatthews in the chat, and I'll answer a few questions here for a few minutes before we call this stream quits. But if you need to go now, thanks for joining me, everyone, and looking forward to seeing you next time we're here. I see Alex K saying, I want my credit. I told you no such thing as temporary government programs. Yeah, I mean, it's true, Alex. I know on previous streams you're saying, hey, maybe these things are here to stay. And with low interest rates, maybe the government is more likely to spend more because they don't have to pay as much to service their debt. So Tyrios, I hope you're not butchering your name. Russell, all problems stem from fiat money. Until governments can't buy votes by putting us into debt, no problems will be solved. Yeah, I think there's definitely a lot of problems with the fiat money system. Anything where you can have these central parties or central bankers controlling the supply of that currency, I'm not a big fan of that. And that's why personally I've sort of gone more heavily into digital assets, largely Ethereum and a little bit of Bitcoin, because these are sort of financial assets that are sort of more so free from the tinkering of central bankers, although macro markets definitely have effects on those sort of more risk-on assets as well. But that's what makes me interested in it for sure. RC says, Russell, good time to eliminate debt? I mean, it's always a good time to eliminate bad debt. This is something we talk about in the Canada Money Mastery program, the difference between bad debt and good debt. Low interest debt, if it's on something that is a productive asset that can make you more interest or make you more gains than the interest rate you're paying on that debt, again, for people who know how to manage that, that debt isn't necessarily a bad thing. Like if you have real estate, like a house or something like this, that you can rent out for more than and make more than the interest rate that you're paying on that debt, then it makes sense to buy more assets with debt as long as you have the cash flow to manage the payments on that debt. Now, on the other hand, bad debt. This is most of consumer debt. Credit cards, some lines of credit if they're at a high interest rate, some auto loans. And depending on your credit score, any sort of loan could be a higher interest rate loan. I think it's always a good time to sort of be paying down that bad debt, especially if it's above 5, 6, 7%. Credit cards are sometimes around 20%. It's very difficult to get a return better than 20% in investments. So instead, why not just pay down your debt for which you're paying that high interest rate? And it's essentially like you're making that interest rate that you would have been paying in investment gains. That's the way that I generally look at it. Curious George says, I heard of a federal debt consolidation program for individuals and small businesses. Where does one find info on the program? I'm not entirely sure. There's a chance that there could be links on the CRA's website if your debt is with them, but there could be sort of other more local debt programs that can help people out consolidating their debt into low interest rates. This is sort of a question around the bad debt, good debt. If there's any way that you can sort of lump all of your debt that might be high interest rates into like a line of credit or a low interest rate, that can often be a good thing to do. And as always, a disclaimer, none of this is financial advice, just sort of information for you to do your own research to make your own decision. I always have to say that. We've got, are they printing money? Well, no longer are they printing money or adding money to the system. They stopped quantitative easing in October, but what they are continuing to do is whenever that the Bank of Canada or the Government of Canada bonds that are on the Bank of Canada's balance sheet, whenever they expire, they're using the money that they get from that payout to repurchase Bank of Canada bond or Government of Canada bonds. So there's still like the cycling of that new money happening to fund the government and to keep interest rates low because they're keeping bond prices high. But no new money is being added currently. They've sort of taken their foot off the gas of quantitative easing. Not so in the States though, so that's interesting to look at. Mortgage rates, any changes from B14? There could be some slight mortgage rate changes just because of this forward guidance expectation that interest rates will go up. So you do have to think twice if you're going to lock into a variable rate mortgage. Oftentimes variable rate mortgages are good. As long as you do the calculations for the savings you're making on interest payments into the future and you're confident that that savings is going to be more than whatever amount you're going to have to pay extra if interest rates go up. Also, variable rates are good for people often if they do have excess cash flow. Maybe you're making, you're living below your means and you're making more and able to save more. Well, there's less risk for you to take on a variable rate mortgage because even if you have to pay more in the future when rates go up, you're going to be able to. So that's my thoughts on mortgage rates currently. But it could be a good time to lock in a 5-year fixed rate mortgage while rates are still a little bit low. But again, this is something that you should talk to your mortgage broker about. Ryan Brown says, Russell, any gut feeling about what the Fed will do? Well, I mean, I think that they've got to slowly start eking up rates, but the markets are going to be sort of reactive of that. There's a good chance that the markets have already priced in a quarter point interest rate rise from the Fed. We saw every single market absolutely tank over the past week as more hawkish outlooks for interest rates sort of propagated across people who are investing. Many people moving from risk on assets, more risky assets that you need when interest rates are so low because you can't get that interest rate anywhere else really. People like sort of pile into these high risk assets. I think that we're seeing a slide of people down the risk curve to less risky things as they expect interest rates to rise and have those tech stocks and maybe cryptocurrencies negatively impacted by that. I'm not sure what they're going to do. Many people expect that 0.25 rate increase, but that remains to be seen. I think it'll be a shocker, just like it was today, if they don't do anything, because inflation is becoming a political issue in the States as well. Hopefully that helps you out, Ryan. Maybe not what you wanted to hear. Yeah, Candace from Mountain Finance, great channel. If you're watching, you can check her out. Usually the fear of what Powell may say has the bigger effects on the market. Yeah, Jerome Powell, the chair of the Federal Reserve, often what that man says, this is the signal forward guidance. If we signal things hard enough, maybe the market will react. And that's often what happens with Jerome Powell, Jay Powell. Yeah. So I think at that, I think we're going to close down the stream for today. So I want to thank you guys for hanging out and tuning in and supporting the channel. Likely more content to come as the month turns over, as we start to get some responses from the government, the actual politicians, because they've been on their non-House of Commons break from December 17th to January 31st. So as we see the month flip over here, we're going to get more comments from them and likely a lot of pressure about inflation, especially given the lack of an interest rate hike here. So definitely subscribe if you haven't already done so. Hit the notification bell so you can know when new videos are coming out and so that you can tune in when these live streams go. I think you get a notification when that live stream goes live if you hit that button. So I appreciate all the support and thanks for tuning in, everyone, and I'll see you next time. Have a good one, everyone. Bye.